Well, folks, we have some massive things occurring in the stock market right now. Some of it's right in front of our face, some of it's beneath the surface. We got to get into this, okay? Posted this on X just about an hour ago or so. Looks like about 22,000 people have gotten to see it so far. I said there's a stock that's up 160% from where it was less than 2 months ago. Gains that index fund investors would hope to make over 10 or 15 years. The stock is given in weeks. Can you guess what stock it is? We're going to talk about that stock, and we're going to discuss here at the beginning of the video how much more upside does a stock really have? Can it keep running? Because it's been a ridiculous move so far. And after we get done going through that, I want to get into this one. Wells Fargo's Chris Harvey predicts the S&P 500 will jump 16%. That's a big move from here, folks. So looking forward to reacting to that one. The Fed's 2025 rate path, here's the latest on that from 3 hours ago. Steve Leisman talking about where the Fed's headed here. I think that's an important video. Brad Gerstner went on CNBC here today, spoke about his views on the market, where the market's headed, where the economy's headed, where certain stocks are the best opportunity. So looking forward to reacting to that, share my opinions and perspectives there. Roger Altman from Evercore speaking about what he expects with the economy and the market. The man's been in the market for a little bit of time, I would say. So looking forward to hearing his thoughts on that. And then Adobe, we'll speak about Adobe at the end of this video here today and my feelings on their earnings, which literally just came out about less than 30 minutes ago. So looking forward to getting into that as well. So busy video, man. One thing I only need from you guys. One thing. Please do it for me. Smash a like button. That's all I need from you guys. My guess is 70,000 people are going to see this video. And my hope is if 70,000 people see this video, at least 7,000 of the 70,000 smash a like button. That's my goal, man. I appreciate you for doing that. And I appreciate y'all for being subscribed to the channel. New all-time high subscribers in the history of the channel, which we're getting close to 100,000 now on this channel. So I appreciate y'all for being here, okay? Alrighty, so can you guess what stock that is? Guess it, guess it, guess it. I'll tell you what it is. It is this one. Elf on a shelf. I posted this inside the Private Stock Group actually earlier in the morning. I said ELF is now up 160% from where it was less than 2 months ago. The same return most would hope for 10 plus years being an index fund, right? Unbelievable move it has been for ELF. I mean, 160% in less than 2 months. Unbelievable. But the question is, is it justified? Does it have further to go? Those sorts of things, right? Well, here's the deal with ELF. ELF really trades off of two core things, really is what ELF trades off of. One is revenue growth, the other is margin growth. Now, there will be a day when the PE ratio matters substantially for ELF, but that's not today. That's probably, still a few years out in regards to earnings per share really dictating where the stock is headed. For right now, people care about revenue growth when it comes to ELF and margin growth. People tend to take the perspective when it comes to ELF stock of like, if I just wanted to own a stock that was like slow growth but had good earnings per share, I would own some other stock. I want to own ELF because I want them to have those big insane growth rates, right? And we do know ELF is setting up to get back to insane growth rates. One, when that acquisition clears, likely in the back half of this year at some point in time. The road acquisition, that's going to be huge for them, right? Additionally, they're going to come off of way easier comps. And then with the international expansion of the business, plus then the price hikes, we could be talking about ELF in the back half of the year gets back to, we can call it extremely strong double-digit growth. Some say maybe even a triple-digit. I don't know. I don't want to go that far, right? But would I be surprised at all to see extremely strong double-digit growth for this company get back to in the back half of this year and then moving into next year? I think that's what's going to play out. And when I talk about strong double-digit growth, I mean, we could be talking about, it depends on what quarter the road acquisition closes, but we could be talking about growth rates in the back half of the year, which that you won't even begin to see any of that really come till the fall time. But I wouldn't be surprised if you start to see growth rates between 30 and 50%. For this company, right? And then the question is, can they keep that up for a year or a few years? And my answer is probably. They probably will be able to keep that up for a couple of years, right? So it's going to be massive. Now, in regards to analysts here, analysts haven't really brought their numbers up that much yet. And I think they're all waiting for the road acquisition to clear and then, to get more certainty on the tariff situation. So we've got still a whole cycle in regards to ELF that's going to be pretty exciting, which will be analysts bringing up their numbers and up their numbers and up their numbers, at least in terms of revenue growth. That's my perspective on this. for the next bit of time, right? So you look at ELF and you say, okay, so they're going up on price of their products, right? The tariff stuff is much clearer than it was, right? We know they're going to be able to offset that. You got the road acquisition rolling through, right? That should get approved. And the stock used to be $200 plus. And so you start to say, why shouldn't it be $200? And that's a fair question. Should it be $200 right now, right? Instead of $120 something, $129 or whatever, right? So now, there's something else big going on here with ELF that I think I have to point out. And that is the stock price. Now, it's the elephant in the room. We're all watching the stock go up so much, right? And all of us that are shareholders are like, this is beautiful, like 160% in less than 2 months. Come on, baby. Give me more. Who's putting all this buying pressure day after day? Because you're seeing ELF make these big upward moves even on down days. Look what happened to ELF yesterday, right? I talked about ELF on the main channel yesterday, just a very small amount, not big in depth like this is, right? But if I recall, ELF was up 5% plus yesterday. Yesterday, the indexes were red. Today, I think it was a Red Dead Redemption Day, if I recall, again out there, was it not? In regards to the market today, let's go ahead and take a peek. I think all the indexes finished red again here today, didn't it? Let's take a peek. Okay, S&P 500 finished up today. The Russell, which matters much more for, I would say, ELF, was actually down. So the Russell was red here today. S&P 500 up slightly. Nasdaq up slightly, right? But once again, the Russell that matters more for ELF was actually down, and yet ELF was still up over 3% today. That's interesting. Somebody's putting buying pressure day in and day out, and substantial buying pressure to keep having the stock go up, right? And it's clear, like, the people that are shareholders of the company are like, I don't need to sell right now, right? Because the people are thinking, like, this stock's still headed back to 200 plus, and then long term, maybe it's a $500 to $1,000 stock, right? And it becomes a cosmetics giant, which, keep in mind, cosmetics giants trade for market capitalizations in the tens of billions of dollars, if not $100 billion plus. I have a history of that. And so ELF still is, what, a $7 billion market cap or so? So if you're really playing the long-term game, you probably think ELF's on its way to being, a multi-tens of billions of dollars of market capitalization, which means a long upside ahead, and maybe the stock heads to $500 to $1,000 a share over the coming years. Wells Fargo, Chris Harvey predicts S&P 500 will jump 16%.
He is with us here. So why are you so bullish then? You're looking for 16% upside from here when there is still so many known unknowns or unknown knowns.
If you look at things, right, there's a narrative and then there's the fundamentals. Credit spreads, 85 basis points over, not very recessionary. If we look at the IPO market, the M&A market, we were worried about that. IPO market is hot. M&A market's beginning to come back. If we talk,
to be quite frank with you guys, the IPO market is way too hot. It's insane right now. Now, when the IPO market starts to turn the other way, then you'll know the market's starting to go a little more risk off and not as interested in risk on. But seeing that IPO market right now almost scares me a little bit.
About the change in regulation. We haven't even seen the benefit in the change in regulation just yet. If we get some sort of trade progress, and we're all talking about China, but when I look at what happened with India, some of the rhetoric coming out of the Indian-U.S. negotiation, that was actually pretty positive, right? That could be the template. And what did Wallace say not that long ago? Hey, if we only have 10% tariffs, we can start cutting rates. Now we start cutting rates, that's a whole new ballgame. And if we do have resolution, not resolution, we won't have resolution, but if we do make tangible progress on trade and tariff, you can start looking through that bad news and you'll start looking to 2026, and that's pretty good.
How do you look past, though, the way that investors and or consumers feel when we talk about the soft data?
I discount the soft data heavily, right? I am trying to talk to anybody who will talk to me on jobs, right? We're hearing a lot of noise about jobs, but I can't find the real pain, right? We're talking to economists, we're talking to corporations, we're talking to analysts. You see pockets of it, but there's nothing systemic. And the soft data, it's just not there. We went through the presidential election cycle. Soft data didn't work. The predictive data did work. And that's where we're placing our bets. That's where we're placing most of that focus. And that is supporting the hard data.
My worry about the jobs, though, is that we may not have seen it yet if companies are going through these various...
I want to show you guys something I posted to my private stock group members late last night. I posted this. I said, I honestly no longer care about the type of market we are in when it comes to an emotional feeling. I used to get emotional about the market being too much story mode or too much now mode. Story mode is just a fancy way of saying like the market's just all about the story, all about the hype, the excitement. Stocks are trading at crazy valuations. People don't care about the fundamentals of companies, right? And now mode is when people don't care about the story at all and don't care about the growth rates the companies have. They only care about what the company's doing today and what their earnings per share is today, right? I said it used to frustrate me. Now I could care less. I observe where we are, make adjustments, and that's that. I can't control how now mode or story mode the market is. I can control what I do with my money and the adjustments I make. Control what you can control, right? And, you know, it brings me back to this whole point about IPOs being really hot. Like, I would prefer to not see the IPO market this hot. Like, it's just way too hot for my comfort level. With that being said, I don't care to get emotional about it. I just observe it. I am aware of what's going on, and I make sure I'm just not feeding into that sort of kind of FOMO, hypey feeling, right? And then making investment decisions based upon that, saying, oh my gosh, all these IPOs are moving. Maybe I should buy the next IPO when it comes out because, gosh, it's going to shoot up 70%. Like, I better buy it right now. Like, I just stay away from all that, you know, because it just gets you in a bad state, gets you in a bad mentality, start trading around. Some things go your way initially, then they start not going your way, and then you start looking around, you're like, oh my gosh, like, why is this not going around? Then you start chasing bets instead of making investments. It ends poorly, right? And, you know, these are all lessons I teach you in my private stock group, you know, in a lot of those different course curriculums and whatnot to avoid all that crap, stay focused on your investments. And when you do that, man, you just find it's so much easier of a game to play, and there's just so much more money to be made. It might not be as exciting, but it depends on if you derive excitement by gambling or if you derive excitement by actually making long-term sustainable money, right? I like to make a lot of money over time. And so, you know, the rest is going to be what the rest is going to be.
Mitigation strategies to try to cut costs elsewhere. And that one big way to cut costs, unfortunately, is to cut payroll. And so maybe we just haven't seen that yet. I mean, is that factored into this?
Yeah, that's fair, right? So the comment before was, do tariffs work with a lag? Possibly, right? And the other thing that we talk about is uncertainty, right? And I'll throw out a comment that probably won't make sense at first. If you don't know, you know, right? If we get to the middle of summertime, we still don't know, then you know you have to make those hard choices. You know you have to cut costs. You know that you have to reduce the labor force, and everyone will do it together, and that is the big fear.
Chris, when you look at rates, you talked a little bit about it before, but when you look at the CPI number, the biggest in CPI and PPI are shelter costs.
Right.
So those went up, but gasoline went down, and that dragged down the overall headline number. Where do you see that going? How does shelter costs come in? Because that's the only tailwind for this economy is if the mortgage rates come down.
Right. So mortgage rates can actually come down if you get volatility in the rate market down. The way you get volatility in the rate market down is the Fed starts giving you forward guidance. The Fed starts telling you what we're going to do 3 months, 6 months, 12 months in advance. We may get that, right? And then you can have rates stay where they are. That volatility starts to compress and mortgage rates come down. That would be a real plus. But also what I would add to that is I think we missed a big opportunity. The U.S. administration could have done something on tariffs, not tariffs, on the deficit. They did not. That would have been a home run trade. That would have rallied mortgages. That would have rallied treasuries, mortgages, so on and so forth, made things much more affordable. That was a big missed opportunity.
You were here at the end of March. You were bullish. That proved to be right. How do you wrap your head around, though, the current S&P valuation, which is high by any historical standard?
So in my take, there's a great, you talked about it before, there's a great secular AI trade. And I lived through late 90s, and we went back to late 90s, and we tried to make the comparison. And at the end of the day, it's not a fair comparison. Back then, you had WorldCom, Quest, Global Crossing, Level 3, all super levered companies going to the credit markets, tapping those credit markets, and leveraging up even more to put fiber in the ground. And the philosophy was build it, and they will come. Today, you have some of the best and the brightest, right, spending on CapEx out of their own pocket. And what you have is something more analogous to Wintel, where the infrastructure or the innovation is sitting right on top of the infrastructure and one is feeding the other. Jensen over at NVIDIA, that phrase that he has, we are producing AI factories. We're producing AI plants. It's a good one, and I believe with that, or I believe in that. And so
Chris,
there's still that great secular story.
I hate to cut you off.
Okay, so, a few things. We'll touch on, his market call there in just a minute. But this is huge. The point he just made, so big that everybody understands this right now. You see all these companies spending like crazy on AI, right? And some people have brought it back over the last year or two to the tech bubble days, and all the spending on internet infrastructure because the internet was going to be this big thing, and that was true. It just took longer time for things to play out, and a lot of companies went bankrupt and blah, blah, blah. The main differentiating factor, I think, there's several, but the main one is, when he talks about those companies from back in the day, they did not have some massive successful businesses that were cash cows that then they could go reinvest for this next big opportunity that was the internet. If you look at all these companies spending fortunes of money, billions of dollars, tens of billions of dollars on all these NVIDIA chips and even AMD chips, and a lot more in AMD chips in the future, by the way, AMD. Might do a main channel video on that one tomorrow once I, look over everything that transpired here today, and I can, put together a really good in-depth AMD video for you guys. But all those companies spend a lot of money. They've got incredibly successful business models that, are the most profitable business models we've ever seen in the history of mankind. And so they got the money to invest into their companies, right? And buy all these chips and buy all this infrastructure. It's not like they're having to lever up, as he was mentioned there, and take out a bunch of debt, right? Now, his call on the market, my perspective is that is probably a little too bullish, at least in my personal opinion. Like, we've ran a lot. Could we have more upside? Yes, but I worry about we're going to pull so much of it forward here in the summertime that by the fall time, we're going to be looking and thinking about risk factors again. And that's going to cause a market to kind of flip and switch. So it depends on where this thing shakes out in terms of the market. But I do worry if we keep going more and more risk on this summer, as we go throughout June, then into July, then into August, into early September, I worry we're going to pull all gains forward, and we could be setting up for some major downside risk come fall time. And then we'll be talking about a fall of the fall, right? Alrighty, let's talk about the Fed's 2025 rate path.
Steve Leisman with the latest on the economic front, Steve, and some new comments from the president on Fed Chair Powell in the past hour.
Yeah, Kelly, welcoming the...
Hey, who really enjoys the reaction channel? I appreciate you guys. I really enjoy this channel. I really like it. I like it almost as much as the main channel.
Lower inflation reports the past
Maybe
2 days.
So.
Forecasters are still puzzling over the mystery of where and when the tariffs are going to increase, and will they show up, if they do, at all. Producer prices well under control, up just 0.1 on the headline and the core, both better than expectations. That followed a tame consumer price report yesterday. Not surprisingly, both reports lead to an expectation of a very modest increase in the PCE price index. That's the Fed's preferred indicator. Estimates range from 0.1 to 0.2, both pretty tame. Evercore ISI saying, although we expect tariffs to eventually lead to higher inflation, repeatedly soft inflation prints could suggest weaker than expected tariff pass-through, marginally reducing upside risk to inflation and lowering a bit the bar for the extent of labor market weakness the Fed would need to see cuts in September. But what about this tariff mystery? One idea, they could be absorbed in profits by exporters, wholesalers, and retailers, with only a bit reaching the consumer. They could be offset by price declines in other goods because of economic weakness or other issues like what led to airline fares declining. And of course, there's this story of maybe they are still to come. Markets looking more confidently, you can see, for 2 rate cuts this year with a roughly 75% probability of cuts in September and December, both higher after the 2 inflation reports of the past 2 days. But note, the probabilities remain low for July, so the consensus is that the Fed is going to wait a couple meetings to be sure, Kelly, that the tariff mystery is solved in a good way before cutting. Kelly?
And Steve, here's what the president said about Fed Chair Powell, speaking from the White House just a short while ago.
If we would lower the interest rates by 1 point, we'd pay about 1 point less. That's $300 billion a year. But I'm not going to fire him. We want to get rid of inflation, and we have. But we're going to be paying more for debt. And all he has to do is lower it. Europe's done 10 lowerings. We've done none.
So, Steve, he's now...
Of course, Kelly, I find that amusing because I wrote this 2 weeks ago, that if the Fed were to lower or the interest rates were to fall a percentage point, but I wrote that in context of if the Fed is not cutting rates because it's uncertain of the impact from tariffs, then the president should get rid of the tariffs so the Fed could cut rates, and it would be a better deal in terms of the fiscal
outcome
impulse into outcome in terms of treasury in the treasury market.
So in other
because
words,
you just do better, you pay less on rates.
The president's going to say,
go ahead,
so he'd probably say, well, I want my $300 billion from tariffs and I want my $300 billion from lower rates. But the problem is, as I see it, is kind of the problem from last fall. The Fed cuts rates before the market thinks it's appropriate, although it is priced in right now. You could get the long end moving higher, but the market is priced for it. So maybe this time is different.
That's exactly what I was going to say, Kelly. If you look at, for example, the 210 spread, it has been relatively steeper. So the market on the long end doesn't seem to be welcoming lower rates, and all the 2 years seems to be doing is reacting to expectations of the Fed. So it will go from 390 to 4, and it's in that range. But that 10-year seems to spike up to 450. I know we have that 10-year auction coming up. I think that's going to be important. But the long-term trend, I learned this from Santelli, by the way, is to look at the ranges. It looks like 430, 435 is the bottom end. 450 seems to be the top end around there, somewhere in that range. But the long end of the market is not anticipating, or I think, hoping for a big rate cut, because I think there is that still existent inflation concern that we have to work out over the summer.
So it's extremely important for the economy for 2026 that in 2025, for the remainder of 2025, we see the 10-year go down. Like, of course, it's not going to go down every day or every week, but we need to see it going down. And because the 10-year is extremely important it's important for a lot of companies, but it's really important for mortgage rates. Like, it's important for many various reasons, but mortgage rates. If we're going to talk about home building, I always tell you guys, most important thing to happen to the U.S. economy is a new home gets built. So many jobs are created when that happens, right? If we talk about mortgage rates stay insanely high this year and the home builders have really weak numbers for the remainder of this year in terms of new contracts signed, then we could be talking about that negatively impacting the economy in at least a decent way next year, right? And that would not be ideal. And so to keep the economy strong, you got to keep home building strong, and we need lower mortgage rates because a lot of people just do not feel comfortable going out there and buying a home right now with mortgage rates up here, right? Now, the home builders do have the whole card that they pull sometimes where they'll essentially give you like a teaser rate for the first year, the first few years or something like that, some sort of mortgage rate buy down. So they do have that card to at least a certain extent, but at the end of the day, like, we need to get these mortgage rates down. If you talk about mortgage rates could get in the 5s by the end of this year, beginning of next year, then we're in business. Then we're talking. I think, people feel much more comfortable about buying a new home, especially with a lot of the home builders doing the incentives they're doing, if you get mortgage rates into the 5s, right? All right, time to listen to Brad Gerstner.
On the BG2 podcast last year, it's when people were saying, oh, this training is hitting an upper bound and all this AI is overblown. And remember, NVIDIA fell and all these AI stocks were falling. And Jensen Huang said on the podcast, he said, we are now moving into inference time reasoning where the machines begin to recursively think for themselves. And he said at that moment, inference isn't going to 10x. It isn't going to 100x. It isn't going to million x. It's going to 1 billion x. Everything in the world is going to be inference. And what has happened this year? Exactly what he said. The token production at Google has gone parabolic. At Amazon, parabolic. Why? Because everybody in the world is using ChatGPT to get answers to their consumer questions. Every single search now on Google is an inference search because they want to give an AI answer. The era of 10 blue links is dead. And now every single person on the planet expects answers. And for enterprises, they expect the same. And I will tell you, we are in the first inning. It may be the first batter in the first inning. And so it feels like a lot. But what we're seeing this year, what we're hearing, these moves by the biggest companies on the planet, none of this is surprising. This is the beginning of a massive wave. Oracle reported last night. right? Incredible numbers, accelerating numbers in terms of the data center and compute build out. Jensen Huang said over in Paris this week, he estimates $1.5 trillion of AI compute build out. On the Middle East visit that I was on recently, we're going to build massive Stargate cluster in the UAE. They're going to build in Saudi Arabia. We're going to diffuse AI technology from the United States critically around the world with the repeal of the Biden diffusion rule, which was essential. And so we are in this phase of acceleration. It's not to say that there won't be companies, right, that get overvalued in that phase. But I just gave a talk this past weekend at my 25th business school reunion up in Boston. And I talked about Henry Blodgett's $400 call on Amazon back in 2000, right? What do you think Amazon is today relative to the $400 call that Henry Blodgett made in 2000?
20,000.
He got ridiculed and laughed off of Wall Street for it.
20,000.
But Amazon is up 87 times today from where it was when he made that call. The reality is we overestimate in the very short term what these things will do, but we dramatically underestimate in the long term. And that's what I think you see in the market today. You see this acceleration because every one of the smartest players in Silicon Valley, whether you're running Amazon, whether you're running Meta, whether you're running OpenAI, whether you're running Google, they all tell me the same thing. We have to do whatever it takes in order to capture and invest in that future. That's why their CapEx is going parabolic. That is great for the entire AI compute stack, whether you're TSM, whether you're NVIDIA, whether you're CoreWeave, where we're investors as well. All of these companies, ARM, et cetera, are going to benefit from that compute build out. And then now we're seeing it in the applications, right? The companies I mentioned, like Snowflake and Databricks, we're seeing it, in the end user applications where we're seeing accelerating growth at places like ChatGPT, right? ChatGPT got to 1 billion searches a day, right? 8 years faster than Google did. This is not internet time. This is AI hyperspeed. It is way faster. OpenAI today is 4 times the size that Google was when it went public in terms of revenue, in terms of searches, right? So I think for people,
Yeah, but to be fair, Google was like a completely kind of new concept. It's not like, if you look at OpenAI, it's just kind of like a derivative of Google search, right? It's just a derivative of it. It's just taking it to the next level. And also the other big thing I think nowadays is products and services can go so viral, right? That's how these makeup brands or whatever company can all of a sudden go from, a non-existent company to like $100 million of revenue in 3 years, whatever, it's like the ability to go viral on social media and like the word to spread about a new service or product is exponential. It's like nothing like it was 20 or 30 years ago. I can tell you that much.
Now is a time where people could say the market bounced a lot off the bottom. Right. I came on here when, earlier this year and said we had taken our exposures way down because I wasn't sure whether government was going to be supportive or whether it was going to get in the way of this AI super cycle. Now it's very clear to me they are pushing it. They know in order for America to win in the balance of global power, we must win in AI.
So, Malcolm, don't look at from the bottom to today. Look at from today to as far as tomorrow, literally and figuratively, can bring you in thinking about these stocks. Everybody owns Amazon on the desk today. You own Oracle, so you understand what Brad's talking about. How do you see these stocks now?
So let me first clarify, I don't own Oracle personally, but a number of our clients do. But I completely agree. I listened to the Oracle call, for example, and I hear Ellison talk about how he's getting phone calls from CEOs who are saying to him, I just need the capacity regardless of where it has to come from. Go get me capacity and I will pay you for it. Probably not in the history since the invention of the internet has that kind of a conversation and that kind of a gold rush been the conversation. So you're talking to somebody whose own personal portfolio over-indexes by a wide margin to software and a lot of the companies that we're talking about. So where you talk about tomorrow and what does tomorrow look like, my one concern in this conversation we're having, not looking the next 2 years, 5 years, 10 years, but just over the next couple of quarters, we don't know how much of the great earnings that Josh was talking about before from Q1 was the pull forward from folks worried about April 2nd. we won't know for another 3 or 4 weeks. And so this is the moment where the markets probably continue to chop sideways until we start to get into Q2 earnings and find out the answer to that. That's my one concern with relation to how hot the market feels like it's rolling right now. We could be about to get some pretty soft guidance from CEOs, which changes a lot of people's attitudes and appetites.
I thought
Well, you know, a great example is what happened today. I don't know if you guys saw what transpired today, but something huge happened. AMD had their day, right? Remember I told you I might do a main channel video tomorrow all on this AMD day they had, right? But did you notice at the AMD day, just about every single major tech company you could have wanted to be at AMD day was there, right? With high-level executives. And AMD's the number 2 player in the market. NVIDIA's the biggest player in the market, right? But yet, every single pretty much big tech company out there wanted to be represented at that AMD day and sent high-level executives. Some even sent their CEOs to be at this AMD day, which shows you the power definitely companies like NVIDIA and AMD certainly have in this marketplace right now. These companies are begging them for as many chips as they can get their hands on, right? And it's going to remain like that for at least a few years. So, yeah, you know, definitely, you know, if you are an NVIDIA shareholder, an AMD shareholder, I think you should feel pretty comfortable.
AWS CEO, Josh, gave us a pretty good reality check. Is literally, you know, we're talking $35 billion in a couple of days about data center, not to mention the billions that the company is investing around the globe. You own the stock too.
Yeah, it's I would say at this moment, it's my favorite of the Mag 7 names. And obviously AI and data centers are a really big part of that story. I just think there's still a lot of money that could come into the name as they start to pull the levers that they are able to pull. And we're starting to see like the real-time results of all of this CapEx. And it's not just about we have to invest now for 3 years, but it's like, no, you don't understand. We're investing now because right now the activity is happening. The land grab is in full effect. I think one of the things that we have to continue to remind ourselves is that the tariff-related situations in the stock market, most of them are not Apple. Most of them are just not terribly important to what the index does. So, and those stocks that have a tariff issue have already been punished. We have just seen absolute whippings in the apparel sector. Look at Nike. Nike is in addition to all its other problems, is a tariff problem. And so it's not as though we're not pricing in these issues. It's that until now, they just haven't affected NVIDIA, haven't affected Microsoft, and they may not. We don't know.
I mean, to be fair, they have, though. You know, the whole China chip restrictions are huge for NVIDIA, huge for AMD. So I don't want to, you know, us to act like it hasn't hit those companies as well. It's just they can weather the storm a little better.
Well, NVIDIA took a massive write-down on China-related stuff.
Yeah, exactly.
And the stock rallied. So, you know,
But it's not like it didn't take a hit. It absolutely took a hit. It's just NVIDIA's numbers are so strong. The company's so amazing that they can, you know, overcome
pricing in the impact of the trade war. We are pricing these things in. It's happening on an individual company basis rather than a market-wide basis. And the reason is the biggest market cap companies that are providing most of the earnings growth for the S&P 500 based on bottoms-up outlooks are not going to be affected by tariffs until tariffs spill over and become like an unemployment story. But that hasn't happened 100%. Yet. So we're kind of in this stasis, and what we have is effectively earnings growth coming from the most important and the largest market cap companies.
Go ahead. Would you agree that the issue with Amazon's share price, though, specifically as also a shareholder who thinks it's probably the best stock in the Mag 7, the issue may be that investors are considering this an e-commerce play and not paying enough attention to the underlying tech components that you just laid out?
All of the earnings growth is coming from AWS. So if you see the stock rally, it's because people are bullish on AWS.
Not to mention the fact that when I was having the conversation with Matt Garman and the way people are framing to your very question and to Josh's point is that AI, as some have written, Amazon wants to be the marketplace for AI. Forget about the marketplace that we all grew up knowing Amazon as. They see themselves as being just that, but for the revolution and the technological innovations that are happening, for AI in and of itself. You guys hit on other interesting points as well. As we speak about the arms race, it is not just Amazon versus Microsoft versus XYZ company and then the next ones that aren't even public yet. It's the United States versus China. NVIDIA plays a role in that. It plays a role into the trade war, too. Jensen Huang telling CNBC that Huawei, quote, has got China covered if the U.S. doesn't participate there. I thought we had a really interesting conversation with the Andreessen Horowitz general partner, Anj Midha, the angel investor in Anthropic, who talked to me about that arms race and why we have to win it. Let's listen.
This race is happening with or without us, right? Look, it was an extraordinary piece of engineering that DeepSeek put out, right, from China. What it also showed was that our adversaries aren't waiting around for us to get our act together. And so, one way or the other, we don't have a choice but to win.
Brad, I mean, the trade war figures into this conversation heavily, and why there is no choice. We need to come out number one.
This is a critical issue, and I want to unpack two things here, Scott. The first one is about diffusion of American technology to the entire world, right? We call this American AI diffusion. We need the world to run on the American AI stack, okay? A week before the Biden administration left office, they passed a rule called the Biden diffusion rule, which was 100 pages that tiered all the world and said, here are all the rules and hoops you need to jump through if you want to sell chips or models to India, to the UAE, etc. It would have literally devastated our ability to distribute the American AI stack to the rest of the world. It would have been the equivalent of Google in 2002 having to come to Washington, get on bended knee, and beg the FDA of search to allow them to distribute Google to another country, and the world would have ended up running on Baidu, okay? We didn't do that in 2002, and we should not do it today. The good news is the Biden diffusion rule was repealed by Howard Lutnick, and it needs to stay repealed. We should not run into the void and put a whole bunch of rules in place. We should do exactly what we did in the age of the internet. We should allow our companies to compete, and in the future, a year from now, 2 years from now, we decide we need to have speed limits, safety belts, etc. There'll be plenty of time for that. But right now, we need to get the American technology out into the world. The reason for this is because when I was in Saudi Arabia, right, Huawei has gone from 0% market share in Saudi Arabia to 50% market share in Saudi Arabia. You can't tell our friends and allies around the world, like India, like Saudi Arabia, that AI is the most important thing in the world, but we're not going to give you our technology. It's crazy. The Chinese have a full stack. They have chips from Huawei that are only, maybe a half a generation to a generation behind NVIDIA. You just buy more of them. You link them all together, and it's the equivalent. They have the DeepSeek model. They have the full stack. This is an arms race. The U.S. needs to accelerate, and we need to get the decelerationist in Silicon Valley who are trying to use regulatory capture to slow all this down. We need to get them out of the way, and we need to get cooking around the world. That's the rest of the world. As it pertains to China, real quick, Scott, there's this belief, right now, NVIDIA has, it went from 80% market share in China, where all the developers, second largest developer market in the world, were developing in CUDA, right? We had them in an American ecosystem, and we were selling them chips. And NVIDIA was paying the U.S. Treasury billions and billions of dollars of taxes, and they were plowing those profits back into staying in the front. Now we've ceded China to Huawei. By giving them monopoly profits and giving them that entire developer ecosystem, it's going to make it easier for them to win the global AI arms race. We need to get NVIDIA back into China, competing with the B30. We need to take the competition to Huawei in their home market, keep those developers in the CUDA ecosystem, keep that market share. That will make it easier for us to win around the world. So these are critical decisions that government is making right now that will determine the next decade as to whether or not we win in the global AI balance of power. And I think we have to win.
Okay, hold your horses for just one flip and flapjacking moment. Listen, it's clear as day, Brad Gerstner is certainly pro-Trump, anti-Biden. Right? It doesn't take a rocket scientist to figure out that, but based upon his tonality there, right? Which is fine, but let's also be honest about this. Trump's very anti-selling chips to China. So, if you're going to call out Biden for certain things, you call out your side too, mister. Because they're not just making it so easy to say, oh, AMD, NVIDIA, go sell chips to China. No. They're literally blocking them from doing any sort of business. It's devastated Nvidia's numbers in China and AMD. It's almost like their businesses are non-existent there now. It's insane. And so look in the mirror, Mr. Brad Gerstner. All right, next one up here, Roger Altman. He's been in the market a few years. Let's hear his perspective.
Former Deputy Treasury Secretary. Roger, thanks for coming in.
Thanks for having me.
Good to see you. Not sure where you want to start. If you believe...
Well, why don't we pick up on something that you just said, which is Goldman has raised its growth forecast for the year from 1, I think you said, to 1.25.
Yes.
But put that in perspective. At the beginning of the year, the widespread consensus, January 1, for U.S. growth was in the 2s. Now everybody has marked it down. World Bank just came down to 1.4. Goldman had gotten all the way down to 1. And that obviously reflects a slowdown. And a lot of that is usually traced to policy uncertainty or tariff uncertainty. And so what's really going on is the beginning of a slowdown. Now, it's not dreadful. We're not going off a cliff. But the economy is slowly shifting into a lower gear, largely on account of policy. And it's showing up a little bit in the labor market data. Fortunately, not too much yet. But monthly job numbers are coming down. If you look at them over a 2 or 3 year period, there are about twice as many jobs being created per month a year ago as there are now. So I think that's the main headline about the U.S. economy, beginning to slow. Now, equities are very high, and there's a little bit of a contradiction there. And we'll see whether or not, if we see greater evidence of slowdown, and it's really all about the consumer, whether the equity is correct or whether they don't. And obviously the inflation data is helping equities because it's very favorable and benign. But then you say to yourself, why is inflation improving to this degree? Why are oil prices where they are? Why are interest rates come down 30 to 40 basis points? And part of the answer is this
weaker
slowing.
growth.
Yes.
But you could also look at it, Roger, as the administration came in and said, Secretary Bessent was very clear, we're going to see slower growth as we try to move away from...
When it comes to the economy and trying to figure out where the jobs market is headed, let me show you guys a chart here that's very important if you want to understand kind of where the jobs market's likely headed. Is it going to get better? Is it going to get worse? Recessionary, not recessionary? Let me pull that up for you guys right now. Alrighty, folks, this chart is very important. This is United States job openings. And so this chart is going to tell you a lot about the state of the jobs market, right? And, if there's too many open jobs available, then you're going to end up with a lot of inflation in the economy. And, obviously inflation can come from many various ways, but if there's a massive, crazy amount of job openings, then companies have to pay through the nose to get workers in there, right? Which causes, many times a wage price spiral. And so when you look at job openings and how insane they went kind of late 2021 into early 2022, that was problematic actually, because that leads to, too high wages. Now, if job openings go too low, then you start setting a big risk for a potential major recession, right? Now, in terms of right now, we're at a place when it comes to job openings, right, where it's not like, oh my gosh, we're doomed, right? It's not like it's a bad number, but we do have to acknowledge that it is down off a cliff over the past 2 or 3 years, right? Look at where we're at March 2022 and look at where we're at recently in regards to job openings. So the amount of job openings right now, I would say, is still more toward the side of healthy than unhealthy. But if this number keeps coming down over the next, 6 months, you could end up in a jobs-related recession come next year. That's a potential. So that's just something to kind of keep in mind here. Oh, it won't let me back it up to max. It only takes me to a 10-year. But if you look here, same amount of jobs as roughly in 2018. But do keep in mind, there's a lot more people that live in the United States now than lived in the United States in 2018. My guess is at least an additional 10 million people live in the United States in 2025 than in 2028. And that's just a rough guess, 10 million people, but maybe it's 20 million people. So regardless, I would make an argument that the amount of jobs openings is actually a little poorer than it was in 2018 because now you have a lot more people live in the United States, right? So just something to kind of keep in mind there.
A government-fueled, inflation-fueled, stimulus-fueled economy back to the private sector, and also rebalance the entire trading relationship of the globe. And given some of those major risky undertakings, economy so far is holding up well.
Yes, but and look, I want the economy to do well and markets to do well. But when the administration first took office at the very beginning, this idea of an interim disturbance wasn't their message.
True.
When they began to roll out the tariff policies and there was quite a blowback, then they said, look, we're going to have to go through a period of some pain or painfulness. But I mean, that's not what they wanted, and that's not what they initially sought.
The 3-3-3. You wanted 3% GDP, right? You wanted 3% budget deficit. On the trade front, do you think this decline, this slow decline, can be managed with a series of rolling deferrals and extensions and handshakes?
Well, I think there's a growing sense that the impact of tariffs on growth will be a little more moderate than people initially feared. And part of that is the administration's own, it's on, it's off, it's paused, it's delayed. And there's a sense that maybe they won't be end up as high as people thought and for as long as people thought. For example, the biggest duality here or bilateral issue here is China. And what just happened over the last couple of days is a Wall Street Journal editorial says this morning, it's essentially a truce. It's a decision to pause. And I happen to think the Chinese are playing this shrewdly. And even though they don't have as good a hand in the thing from a long-term point of view as we do, because they're so much more export dependent. But we'll see. But I think people are beginning to say the impact of these tariffs, while negative, may not be as high or as big or last as long as we might have initially feared.
Okay, last thing up here, Adobe. So as an Adobe shareholder, how do I feel about their earnings? Well, I post this on X. By the way, if you want to follow me on X, I always have it linked in the description area of all my videos on this channel. So you can certainly follow me on there, or Instagram. It's linked in the description. But I posted Adobe, very good earnings. I'm a happy camper. Any dips I will be buying. My 3-year price target on Adobe is somewhere between $700 and $900. And, as somebody that's up about $13,000 on Adobe stock so far, and it's going pretty well, I think, Adobe has a long way to run here. Looking at their earnings, revenue came in at $11.5 billion versus $10.4 billion at the same quarter last year. Gross profit came in at $10.3 billion versus $9.3 billion in the same quarter last year, so up $1 billion, a very nice number. Operating expenses actually dropped quite a bit for the company year over year, but that was mainly because of this acquisition termination fee they had of $1 billion last year in the same quarter. So their expense profile is still going up because they're spending a lot more on sales and marketing and R&D right now, okay? But operating income exploded to $4.2 billion from $2.7 billion. And then if we look at net income, it went to $3.5 billion from $2.1 billion. Phenomenal. Cash and cash equivalents down a bit for the company, but that's mainly from my understanding because they're doing massive share buybacks. I believe the number was something around 8 million shares they just bought back again. So they're buying back shares left and right now, which I love. I also love this debt number here. That looks beautiful, right? Because there's no number there. Now, other than that, everything looks really good across the board with Adobe. I got to listen to their conference call tonight or tomorrow morning, depending upon when I get to that. So I'll probably listen to that on 1000xstocks.com, which we have a very exciting new feature on 1000x that Ooh. We're working on launching it right now. I got the devs working on it right now. So don't be surprised if it's up at some point tonight. But essentially, AI transcripts of conference calls. So very, very exciting. We just keep pushing 1000x further and further and further. So very exciting times in regards to that. If you're looking to access 1000xstocks.com, plus apply to join my private stock group, private wealth group, get access to all my best course curriculums, teaching you everything I got up here in this head, that will be the pinned comment down there. You can click on that, fill out a form, and we'll see if we can get you access to that maybe this weekend or next week and get you up to a much higher level than where you're at right now. And additionally, for private stock group members that are watching this video, make sure you send in photos. I know we've been sending out a ton of 6-figure, 7-figure trophies recently. A lot of people scale into 6 figures, 7 figures. Make sure you send in your pictures for the Hall of Fame. The Hall of Fame, which is in the Discord chat right here, 6-figure Club Hall of Fame. So many of you guys have hit it recently. Send in your photos. Make it a cool photo too, okay? Don't just do something boring. Like, see, this is cool. I like this. This is a cool 7-figure award trophy right there, baby. So, yeah, make sure you guys are sending in your photos for the Hall of Fame. Alrighty, guys, much love as always, and have a great day.